Ladies and gentlemen, welcome to our latest edition of our Basel 4 channel. Maybe you remember some previous episodes ago we were speaking about the new methodologies for the parameter estimation for the IRB approach. Especially we were speaking about the LGD 2.0. We received a lot of feedback from our clients and a lot of questions regarding this topic. For that we decided to record another episode especially on this topic. Like always, as you know, I'm not doing this Basel 4 channel alone. I will do it again with another colleague of me. It's Kaan Aksel. Kaan, would you like to introduce yourself and give us a quick overview of the agenda?
Sure. Hi, everyone. Today we're going to be discussing about a very important component which has been introduced some time ago into the LGD estimation methodology. And I'm proud to say I've been dealing with such topics for the last 18 years at PwC, and we will be trying to give you a quick snapshot about the key topics, key issues that has been attached to this new methodology. And of course we will give you as well concrete examples why and under which circumstances the methodology might or might not really work.
That sounds really interesting, Kaan. So let's start with the presentation.
Thank you, Martin. I have been in Frankfurt for the last 3 years and have been actually working in the area of credit risk model development and all things around parameter estimation for the last 18, 19 years. And today we will be as well talking about one of these important topics that will be on the agenda of the credit risk models for the next couple of years, together with my colleague Petr Geraskin. Petr.
Thank you, Kaan. My name is Petr Geraskin. I'm Senior Consultant in PwC Frankfurt Regulatory Management team. My projects are mostly related to intersection of regulation and modeling. Currently, LGD IRB modeling is a hot topic for the banks, and I have been involved in several projects in large European banks, and Downturn LGD framework is a significant part of this project. Thus, I hope to share our experience in this regard during this YouTube channel. Thank you, Kaan.
Yeah, we will have briefly the option to go through the main areas to give you some overview of this Downturn LGD framework today. And for the first part, the important distinction is that the EBA in general terms values the diversification in model development practices. So it gives the chance to the model developing institution based on their own internal specific data to enable them a high degree of model development with risk sensitivity. It's obvious though, on the other hand, that granular data and specific guidance on calibration target are the key requirements. The draft guideline focuses more or less on the calibration target. That would mean that the LGD estimates appropriate for economic downturn, which we call the downturn LGD, and not on the calibration methodology applied to ensure the calibration target is met. There is a distinction as well named or underlined as calibration segment. The use of calibration segments doesn't really imply that the institution calibrate the LGD by facility grades or pools by considering the long-run average LGD calculated at the same level, at the level of calibration segments. So, in other words, the downturn LGD and the long-run average LGD should be estimated on segment level if we're doing the calibration on segment level. If it's done on pool level, both should be quantified on pool level. Finally, for RTS, there's a link to the economic downturn, which in this paper it's indicated a view of an economic downturn which might comprise of distinct downward periods where more than one downward period could be identified for some countries in the last 10 years. That could be easily the case. They might have 2 or 3 different years where you have distinctive downturn patterns in the economic cycle. Obviously, the consultancy paper wants the model developing parties to consider these 2 years and choose the highest average LGD, whichever year is producing that. We will have as well some general requirements. The guideline should be understood in that context as an amendment to the guideline on PD and LGD estimation, which appeared towards the end of the year 2017. This implies that all definitions and all relevant requirements of this guideline are in this context as well applicable. The wording, some of the text wording is important for us to explain in detail. The downturn LGD estimate should be quantified at the same level at which the long-run average LGD is quantified, which we have mentioned here, and this is called the calibration target, which in this context means the calibration target on segment level. There could be multiple downturn periods, and for each downturn period, actually the downturn LGD and the side of the long-run average LGD should be estimated. The final downturn LGD estimate should relate to one downturn period for each calibration segment. The downturn LGD estimation subject to the minimum add-on is disregarded where the downturn LGD estimation is possible based on observed or estimated loss data for any downturn period. It should be as well chosen as such that the margin of conservatism is included that result in a higher average downturn LGD estimation on a considered calibration segment. Due to the capital effect, sometimes the LGD grades might migrate from one grade to the next or from one pool to the next, and this affects which we call easily used most of the time as the capital impact stems from the migrations between facility grades and shouldn't lead to an over and underestimation of the LGDs appropriate for any economic downturn over time. LGD should be appropriate for any economic downturn period. If we apply different methodologies for the estimation of long-run average LGD and downturn LGD, comparison of final downturn LGD estimates to the long-run average LGD after application of margin of conservatism for the purpose of choosing the higher estimates should be the key solution, or should be really the basic understanding for the model development in this context. When institutions set a single LGD estimate involving a long-run average LGD estimation and downturn LGD adjustments applied to the long-run average LGD, they should also ensure that the margin of conservatism on the final LGD estimate encompasses the uncertainties stemming from both the long-run average LGD estimation and the calculation of the downturn adjustments to that. There are actually three approaches, mostly on the as the modeling options in this context. The downturn LGD estimation should be based on the observed impact of an economic downturn at relevant losses of the respective institutions. If possible, it should make use of certain prescribed methodologies, but this could be as well quite a lot depending on the availability of data, and therefore actually with respect to the coverage of appropriate margin of conservatism, one should still allow the institutions different ways of dealing with the lack of data or shortage of data, especially on the corporate and non-retail segments. This might be of relevant implication. The three options and approaches are downturn LGD estimation based on observed data, downturn LGD estimation based on estimated historical data, and finally you have the free modeling flexibility with minimum level of add-on giving significant shortage in data. For the downturn LGD estimation based on observed data, where observed loss data is available, we need to assess the impact for the considered downturn period. A fairly prescriptive impact assessment is is expected to be conducted here. The impact assessment must analyze whether there is evidence of elevated realized LGDs, decreased annual recoveries, decreased number of cures, and prolonged time in default caused by the considered economic downturn period. Downturn LGD should then be estimated as well for the considered downturn period in alignment with the results obtained from that impact assessment. The downturn LGD estimation based on estimated historical loss data is usually what we apply. When sufficient loss data is not to the extent available that the downturn LGD could be quantified, then we might be using the so-called haircut approach or an extrapolation approach, which is basically related to estimation of given economic downturn based on historical observation or relationship between the macroeconomic risk drivers and the impact of them on the lost data. These approaches may as well be combined, the two of them, and used for the downturn estimation for intermediate risk parameters. Downturn should only be quantified using these approaches for a considered downturn period if an estimation based on sufficient data is not possible or not reliable in that context. MOC has to be added on the top of that to cover for the lack of lost data impacted by the economic downturn. When and if there is really no data available to quantify the downturn LGD for the considered downturn period, then the banks or the institutions still has to provide downturn LGD estimation. A minimum level of margin of conservatism has to be added on the top of that, covering the lack of data and the methodological deficiencies or mismatches. The institution should justify that if possible, if it's not possible to apply to the previous approaches. This approach requires, free modeling flexibility. In other words, requires that the final downturn LGD estimation includes an appropriate margin of conservatism, and that should be higher than the accordingly estimated long-run average LGD. But this is capped by 105 percentage points based on the exposure amounts in that sense. Here, a final word maybe is valid. The reference value should be proposed, which acts as a challenger to the final downturn LGD estimation under the two approaches and as a guide to the regulatory expectation with regards to the level of quantification. Before I finalize this, just one word of caution. As usual, when it all comes to the LGD modeling, everything is pretty much dependent on the availability of data. And here my colleague Petr will elaborate in more detail about the components of LGD, downturn LGD estimation based on observed impact and based on historical observation.
Kaan, thank you very much for the presentation so far. It was really interesting. Kaan, I have one question, one really important question. When you look to the new methodology proposed by the EBA, is it materially different from the previous methodology? And if it is different, what are the material differences? Could you explain that, please, to me?
Sure. I think the key difference is the downturn LGD estimation was anyway a requirement under CRR. However, we didn't have this full-fledged description how this should have been estimated and calculated. First of all, we have to make sure that the downturn years are estimated based on macroeconomic assessment, and this year should be part of the observation period through which we are actually calculating the long-run average LGD. There are a lot of banks that are using actually the downturn years being not as part of the observation period for a long-run average LGD calculation. This is not anymore acceptable according to the new guideline. More importantly, we need to as well establish a link between the components of the LGD estimation and the macroeconomic variables, macroeconomic factors. And this link should be verified by statistical properties. If you can't do that, we cannot necessarily apply the famously preferred approach of LGD estimation, which is called as well component approach. So in a nutshell, we are telling here and underlining here the very simple fact, most banks going forward most likely need to redevelop their LGD models and estimate the downturn LGD based on the new collected data sets. And that's the key hurdle.
Okay, thank you very much, Kaan, for this answer. I suggest let's go back to the presentation.
Let's start our discussion with downturn LGD based on observed impact. So this approach assumes that bank has enough historical data to estimate realized model subcomponents. Thus, the first step would be to estimate whether a bank really has all the required data for period long enough to cover potential downturn periods. Second step would be to conduct analysis of downturn impact on main LGD model components, and this does not include only realized LGD. However, it also includes annual recoveries, which could decrease due to downturn effect. It should also include number of facilities returned to non-defaulted status, as they could also decrease due to downturn effect. And also, banks should analyze prolonged time in default. Thus, this will ensure that impact of downturn period is analyzed even if it is not measurable purely at level of aggregated realized LGDs. Another option is downturn LGD based on estimated impact. In case if historical data is not available, LGD model, base LGD model can be used to assess downturn effect, particularly if macroeconomic factors identified for downturn analysis are included as risk drivers in bank's LGD model. This model's output could serve as a reasonable approximation for downturn estimates. Where macroeconomic factors which were identified as significant for downturn framework are not aligned with bank's LGD model, existing LGD model can still be used to simulate historical loss data. This historical loss data can be further used to establish dependency between new simulated loss data and macroeconomic factors for purposes of identification of downturn period. More concretely, if bank decides to apply haircut approach, bank should identify model components which depend on macroeconomic condition. In this particular example outlined on the slide, recoveries is this component. Recoveries itself as a component is dependent on collateral property value, discounting, and costs, out of which only property value is dependent on macroeconomics. Thus, this property value will be the driver of downturn LGD. If, for example, property value is dependent on house price index, and house price index is considered as an important macroeconomic factor for downturn framework, then bank can apply haircut approach. On this slide, you can see how basic LGD model intersects with the downturn framework. Left part of the slide represents basic LGD model. Right part of the slide shows which changes should be applied to the basic model in order to account for downturn conditions. Particularly, for the purposes of downturn calculation, we identified model components which are sensitive to macroeconomic conditions and applied haircut to them. Haircut is identified based on analysis of significance of downturn influence on corresponding model components. It is important to mention that potential downturn effect should be estimated for all relevant components of economic loss. As can be seen from the chart, historical loss rates are available back into the past only for 2008. This could be an example outlining extrapolation approach. In this case, before 2008, bank has to apply model in order to generate artificial or simulated loss rates. These loss rates can be further used as a target variable to identify dependence between it and macroeconomic factors for purposes of downturn estimation. Particularly, on the chart it can be seen that downturn period corresponds to the area of simulated loss rates. What is also important to mention is that usage of simulated loss rates leads to additional level of uncertainty, which should therefore be covered by additional margin of conservatism. This outlines the general approaches for downturn estimation and could be used by banks depending on availability of their internal data and complexity of their models and processes.